Welcome back, everybody. It's good to have you. As you know, we are in a crazy hot real estate market here in spring of 2021, both locally here in the Milwaukee area as well as nationally. And a lot of people are scratching their heads and are wondering, when is the real estate market going to crash? Because they are presented with two options that are both not very attractive. You can either jump into a fiercely competitive real estate market right now, or you can remain on the sidelines and wonder what's going to happen with prices going up and interest rates potentially creeping up a little bit, and then you get hit with the double whammy of paying more and financing on a higher interest rate. So today we're going to look into when is the real estate market going to crash, and I'm going to break it down for you. What are the early warning signs? How is that going to unfold? What is the sequence of things that we can look for? What can we expect? And we're going to get after it right now. So from a personal experience, I can tell you it's typically long-term and repeat clients that are asking me the question, when do I think the real estate market is going to crash? And those are people that have known me for a long time. We've worked together. We've maybe fought some glorious real estate battles in the past. So there is a level of trust there. Some of them have actually become really good friends. And they want to know what I think because they know that I study the data a lot. And so, of course, they have the same concern as everybody else. And when I look at the market, it makes me nervous as well. And what I do when I'm nervous is I turn to the data and I look what's going on. So today I want to talk about the timing. When is the market going to crash? Because as everybody knows, no market is going to last forever. There's always a change on the horizon. There's always change going to happen at some point. The question for me is, what is the change going to look like? And I'm not convinced that it's going to be a crash. I actually think that we're going to transition out of the current market into a different market. And the short answer is, from everything that I see in the data right now, when I look on my long range radar, there is nothing on the horizon right now that could disrupt the market as it currently is. So I think for the foreseeable future, we are going to head down the same trajectory. But the question remains, how long is that going to happen, and what are the early warning signs? What can we look out for? So today I want to break it down and examine a little bit on how a real estate market crash or change, if you will, can look like. What is the anatomy of that? What are the early warning signs? What are the phases and sequences that we're going to go through? And hopefully that will help you to answer the question for you personally on your strategy and what you're supposed to do this year in the real estate market. A quick side note. So I believe the reason why so many people are wondering if there is going to be a real estate market crash is because the events of 2008 are so fresh in our collective memories. And we all remember the foreclosures and the price drops and the disaster that followed and crippled our nation for years to come after 2008. But what is easy to forget is the bubble that was building up before that, with the subprime mortgages, with the ninja loans, with the crazy speculation that was going on for almost a decade with what's going on in the banking system, which ultimately has led to that bubble. So if you have not watched the movie The Big Short, I highly recommend it because it puts things in perspective, and you can see how that situation that we have today is so different, almost the inverse in so many things, than what we have experienced in 2006 and 2008. So if you're more interested in that, I have recorded a video recently about comparing the 2008 situation with what's happening currently. I'm not going to repeat all that, but I'm going to put a link up here. So go check it out if you want to refresh your memory about what was going on. All right, so there is one big misconception out there about the real estate market that I would like to clarify today. Real estate markets do not crash overnight. We're all conditioned to this. You come home from work, you turn on the evening news, you hear the stock market has crashed, you pull up your portfolio and you see you're 30% down. Boom. It doesn't happen like this. The real estate market doesn't move like this, obviously. Real estate markets move very, very slowly. It's not a matter of days or weeks, even months, for a real estate market to crash. It happens very slowly when a real estate market changes direction. You can see that when you look at the historic data. Even when you look back into the 2008 bubble, which was almost a decade in building up, and then there were early warning signs 2 years before the crash, and 1 year before the crash the alarm bells really went off, just nobody wanted to see them. So there are early signs, and we're going to take a look at this today. So if you want to compare the real estate market with the stock market, here's a visual for you. think of the stock market more like an avalanche. As the snow is falling in the mountains, it keeps building up and it goes higher and higher and higher and higher until it reaches that breaking point where the whole thing comes crashing down as an avalanche in a matter of seconds. And yes, you can get hit by an avalanche. Now, the real estate market is more like a glacier. It builds up the same way by snowfall, and eventually it will start flowing downhill very, very slowly. A glacier is also very powerful, maybe even more powerful than an avalanche when you look at all the rock that it's pushing downhill, but it moves very slowly and nobody ever gets hit by a glacier. The real estate market kind of behaves the same way as a glacier. It moves slowly, it's very powerful, but you can see it coming and there's early signs that you can study. And in today's video, I would like to break it down for you and we'll take a look at these early warning signs. Here is another side note. This is not a monetized YouTube channel. A lot of you guys watching this and being subscribers of my channel, you are actual clients of mine. We've worked together in the past. You are referring friends or family to me and you trust my judgment, and I take that very, very seriously. So if you want to gauge the condition of the real estate market, then inventory is one of the easiest indicators to look at. We're measuring inventory in months of supply. So when you have an increase in inventory, that indicates that the supply that is coming on the market is exceeding the demand. So because of that, inventory is building up. There's more houses coming on the market than buyers are taking off the market. You have an increase in inventory. And when you look back at the 2008 situation, you can see that already in 2005, inventory started creeping up. It broke that 4 months worth of inventory line. And it became really obvious then in 2006, so a full year before we are actually talking about the beginning of the real estate crash, a full year prior, you could already see inventory reaching critical levels, and it broke the 6 month worth of inventory line. So 6 months is significant because that indicates that we're transitioning from a seller's market into a buyer's market. There's now so much inventory here that the buyers have the upper hand, and we're calling this a buyer's market. And from that point on, it was still yet another year before we hit the height of the bubble and before the market started really crashing. If you fast forward to the present day, the spring of 2021, we have currently less than 1 month worth of inventory here in Milwaukee. And that is pretty much similar than the situation we have on a national level. So I will keep a careful eye on inventory, but inventory is not the first indicator that is telling me when the market starts to slow down or it starts to soften. There is a few other things that we can look at that tell us before inventory starts rising that there is going to be a change in the market. I believe one of the first indications that we're going to see is a change in affordability. Housing affordability is currently very high in Milwaukee. Why is that? On a national comparison, Milwaukee home prices are relatively low. We have extremely low interest rates, we have good growth in wages, and we have very high employment. Even despite the pandemic, 3.8% the last time I checked was the unemployment rate. So because of all these factors, we have a historically very high affordability. So there is, when you put it in historic context, there's quite a bit of room to grow for home prices before affordability comes down to historic averages. The second early warning indicator that we're going to get is a decrease in buyer demand. How can we see that? For me, it's relatively easy because I'm on the ground every day, but you can also see it in the data. Showing time, for example, gives us very precise data of how many showings are conducted every given day in Wisconsin. So when we see a slowdown in that activity, when buyers are not as active anymore looking at new listings, we can see that buyer demand is slowly coming down because showing time activity is coming down. We will also see a decrease in the number of offers that are going to be received on a listing. So at the moment, it is not unusual for a new listing to receive 10 offers. That number will eventually come down to 3 offers, 2 offers, and at some point there's only going to be just 1 offer for 1 new listing. You are still not seeing an increase in inventory because that 1 offer is still consuming that 1 listing. So you're going to observe that very, very clearly. We're going to see as buyer demand is coming down long before we're going to see a change in inventory. And with that, we're coming full circle to inventory. So an increase in inventory is our third early indicator for the market changing direction. So eventually we're going to see 1 month of inventory, then 2 months, then 3 months, then 4 months worth of inventory. Once we hit 6 months worth of inventory, we're officially crossing over from a seller's market to a buyer's market. Now the buyers have the upper hand. But having 3 or 4 months worth of inventory still does not mean that the market is going to crash or prices are going to come down. That simply means that the market is going to level off and it's going to stop appreciating or going up in value. When you look historically, even in 2008, the market was plateauing on prices for about a year. So prices were not coming down. They were just going sideways. And this is a very realistic scenario for today's market, because we might just see at some point a fatigue on the buyer side, where a lot of people are just giving up on home ownership and they're going to say, you know what, home prices have become so expensive or interest rates have become so high that it's financially more feasible for us to continue renting. It's cheaper on a monthly basis than buying a home. And at that point, the market is just leveling off because it's found an equilibrium between supply and demand, and prices have stopped going up. So you need a catalyst, you need something, you need a spark to set a fire to blow the whole thing up. And that is exactly what happened in 2007 and 2008 with the subprime loans and the ninja loans. People couldn't make their payments. They also couldn't refinance because they were underwater, because they were so over leveraged on their houses, and they should have never qualified for a loan before. So they had no other option. Remaining in the house was not an option to them. So they had no other choice than selling. And when they found out that selling was not possible anymore because there were too many houses coming on the market, the next best thing to do was to send the keys back to the bank and go into foreclosure. So you need that catalyst to actually send the market into a downward spiral. So with all that, let me come back to my original question: when is the real estate market going to crash? And the answer to that is, I don't really know, but when I look at my radar, at my midterm and long-term indicators, there is nothing on the horizon right now that makes me believe that there is going to be a crash building up or somehow around the corner. We can look at inventory, we can look at affordability, we can look at interest rates, we can look at buyer sentiment, how many offers we have on every listing, how many showings there are happening. All these indicators are currently pointing that the trend we're currently on is going to be what we're going to be seeing for the next month and for the foreseeable future. So I'm going to continue to keep an eye on the market and watch out for these early indicators and keep you posted if anything is changing. Watch for my monthly market updates. If you're not currently a subscriber, here's a reason to subscribe and stay updated on everything that's going on in the Milwaukee real estate market. And I'll see you next week.